June 13th, 2025. As rockets lit the sky over the Middle East, another kind of explosion happened right on your screen. Bitcoin surged, dumped, and rebounded in just a few hours. Ethereum's gas fees spiked to record levels. Altcoins crashed so hard entire portfolios basically disappeared. This wasn't just another red candle, this was war, colliding with code. In this video, we break down how geopolitical conflict turned the crypto market into a digital battleground. You'll learn why Bitcoin behaves the way it does during war, how Ethereum users were liquidated in minutes, and what you really need to do to protect yourself before the next global shock hits. Let's dive in. June 13th wasn't just a day of violence in the physical world, it was chaos in the digital one too. As missiles flew, Bitcoin rallied 12% in 1 hour, then collapsed 18% the next. Ethereum followed, as did every major token. Oil surged past $130, global equities tanked, and suddenly the crypto market became the eye of a financial storm. Traders didn't have time to think. They had seconds to act. On-chain volume exploded. Centralized exchanges began throttling withdrawals. News alerts were coming faster than the blocks could confirm. This wasn't just volatility. This was a panic pipeline, running from global conflict straight into digital assets. If you didn't have alerts, if you didn't have stop losses, you were underwater before you could even blink. And it's just the beginning. For years, Bitcoin has been described as digital gold, an asset immune to borders, inflation, and political chaos. And for the first few hours of this conflict, that looked true. BTC soared as traders fled fiat. But then, it crashed. Why? Because Bitcoin isn't just a safe haven, it's also the most liquid asset in crypto. When institutions need cash, when whales need to cover losses, when fear grips the market, they sell BTC first. This dual role makes Bitcoin both a shield and a target. It stores value, but it also absorbs panic. So this is why your Bitcoin strategy really needs layers. Cold storage is for your conviction, while liquid BTC is there for when you need to take action. If you only have one position, you're either frozen or, well, completely exposed. While Bitcoin was melting down, Ethereum was, honestly, choking. Gas fees hit $400 per transaction. People tried to move funds, but transactions just failed. Leveraged traders got wiped out, not because they made bad calls, but simply because they couldn't move fast enough. DeFi platforms like Aave and Compound saw millions in liquidations. Positions were liquidated by bots in seconds. Ethereum's strength, its open access, actually became its weakness under pressure. And, this isn't just about high fees, it's about being helpless while your capital evaporates. If you're in DeFi, you need to act before the panic hits. That means using layer 2s like Arbitrum. It means over-collateralizing. It means watching gas like your life depends on it, because honestly, during events like this, it really does. Altcoins didn't just drop, they were slaughtered. Solana lost 25% in just 24 hours. Avalanche tumbled. Chainlink, Phantom, meme coins gone. Even solid projects weren't spared. In a war-driven market, fear doesn't discriminate. Liquidity vanished. Order books thinned. You couldn't sell without losing 20% in slippage. This wasn't a correction, it was a flush. If you held altcoins during this, I feel your pain. But you need to learn this now. Altcoins don't provide protection. They're profit tools when things are stable. In war, they're liabilities. You'd think stablecoins would offer safety, but even they cracked under pressure. Tether depegged on multiple exchanges. USDC liquidity dried up. Rumors spread of sanctions and blacklists. Suddenly the safe zone wasn't so safe. And if your stablecoins were on an exchange that locked up withdrawals, you were trapped. This is why, real stability requires diversification. 3 different stables, multiple wallets, and different chains. Seriously, don't bet your life on a single peg. While most people panicked, whales played chess. They moved millions just before price swings. They spoofed the order book to bait retail into bad positions. They waited for leverage to stack, then triggered crashes to force liquidations. This wasn't random. This was precision warfare. And the worst part, most people didn't even see it happening. If you're serious about surviving this game, you need tools. Whale Alert, Arkham, on-chain watchers. The signs are there, you just need to learn how to read them. This isn't the last crisis. The world is only getting more unstable, and crypto isn't a side market anymore, it's part of the battlefield. Here's your plan. Start with cold storage for your long-term holds. Keep a live stack in stables across chains for emergency swaps. Use recurring buys to stack BTC slowly, not emotionally. Set stop losses before things go south. Write down your keys, print your seed phrases, test your backups. Crypto doesn't reward brilliance, it rewards preparation. When the next war breaks, the winners will be those who didn't flinch because they were already ready. This was Bitcoin in the Crossfire, a glimpse into what happens when geopolitical instability hits decentralized finance head-on. If you found this video helpful, subscribe to Web3 exclusive, like share and drop a comment. Are you building your crypto war plan? Because in the digital battlefield, hesitation is defeat.